bill of exchange and promissory notes. Bill of exchange and promissory note. A and B. A sells the goods to B for rupees 1000. For that, B has to settle the payment. Consideration should be payable. Okay. And B delays the consideration. So naturally, it's a trade parlance only. For A's point of view, B will be debtors, and B's point of view, A will be the creditors. So B being debtors for A's angle, and A being creditors for B's angle. Now what happens here? A wants to have a written document for the amount recoverable from B. There is no such written document here. A has given goods for rupees 1000 without any consideration, or consideration may be payable later on. And B, okay, says okay, I'll pay in words of mouth, oral assurance. Instead of that, A wants to have a written agreement. So now A makes a draft here. Okay, bill of exchange. Bill of exchange. The transaction happened on, say, 1st July 2025. So 1st July 2025, this transaction is from Trichy. Okay, A is in Trichy, and the sale amount is rupees 1000. And here is a written word: a sum of rupees 1000 for value received. Okay. Okay. So a sum of rupees 1000 for value received is payable. Okay. Payable in 3 months. In 3 months. From the date of bill. To the bearer of the bill. Okay. This is drawn by whom? A. A draws this, and here A's details will be there. A. Trichy. Now B probably in Chennai. Accepts and signs here. Okay. B's sign will be there. Accepted. Is that okay? Accepted and sign will be there. Clear? This is what about the bill of exchange. Who is preparing this? A is preparing. The seller, he himself prepares. Usually he will have the document pre-formatted. All these things are pre-formatted. Just writes the required details and sends this bill to B. Okay, sends this bill to B. And B will read and signs after the acceptance, returns it to A. This is called acceptance sent back. Acceptance sent back. Now A has the document. The document signed by B. So in case if there is any dispute and A will show that you have signed for 1000 rupees, give me the 1000 rupees. Is that clear? Who is the writer here? A is the writer. So he is named as drawer of the bill. This bill drawn on B, so he is called drawee of the bill. Drawee of the bill. Is that okay? Who has accepted this bill? B. So B may be called as acceptor of the bill, and A is called acceptee of the bill. Acceptee of the bill. Is that clear? Now A can keep the bill till maturity and get the money in cash on maturity date. Now I'm going to deal with the maturity. Maturity. Before that, what are the components should be there in the bill of entry? Right. So we'll now deal one after one. One after one. This will be bill of entry. This is value of the bill. Value of the bill. And this will be the date of bill and place of bill. Date of bill and place of bill. Place of bill. Okay. Where it is drawn. And why B has to pay 1000 rupees? Why? Why B has to pay 1000 rupees to A? For goods supplied, value received. Am I right? For this reason only, B has to pay 1000 rupees, right? Sometimes you know A and B are close friends. B wants some cash. But A says, I don't have cash. Immediately B draws a rough bill and makes A sign this bill. That signed bill can be discounted with the banker. We'll see that discounting of the bill later on. Without any trade transaction, for my fund requirement, I can prepare a dummy bill, and that dummy bill can be kept in the bank to encash. Yes, so of course that term is called discounting. For my fund requirement, I can make it ready. This is called accommodation bill. That is called accommodation bill. Here, the 1000 rupees payable by B to A is nothing but for a trading purpose. That's why it is called trade bill. This is called trade bill. This ensures what type of bill is this? Trade bill. Okay, trade bill. Okay. And within how many months he has to pay it back? 3 months. Then this is called term of bill. Term of bill. Is that clear? To whom this money will be payable? Whoever the bill is, with whom this bill is available, he can approach and get the money collected. Okay, whoever it may be. I need to collect my money. If I have the bill, I can go and directly ask. Bearer. Registered means somebody name may be there. That particular person can encash. Here it's a bearer bill. Type of bill. We may have either it may be bearer bill or registered bill. Registered bill means the particular person. In 3 months from the date of bill to Mr. X of the bill. So if it is being the Mr. X and you have to pay only Mr. X. Okay. So fifth one is all about bearer bill. Or sometimes it is registered bill. Never bother about the registered bill. In default, we'll study as a bearer bill. The currency what you have in your hand, 100 rupees, 500 rupees currencies you have now, that will be called as a bearer instrument. If I give you a check, 500 rupees, naming your account and other thing in that in favor of your name, then who can encash? Only you can encash. You can deposit in your account. That's called registered bill. That currency is also another bill. I've seen that. In the currency, I have bearer to. The bearer will be eligible. I owe or I promise. Okay, those things are there, right? Have you seen that in your currency? Seen that or not? Huh? So that's a bearer one. Okay. Now, in Indian currency, what happens? This is the bearer bill. Okay. I promise to pay the bearer the sum of 100 rupees. Is that clear? Bearer means whoever may be. If you are holding this 100 rupees, you will be eligible for money's worth. Who is promising to pay this? RBI governor. So here see governor. Reserve Bank of India. Governor is signing here. I promise to pay. It's a promissory note. All the currency what you have in your hand, no, it's a promissory note. Rather than I write the check where in favor of your name, then automatically what happens? That will be called as what? Bearer means registered one. So currency is also one of the good example for bearer bill. Is that clear? I promise to pay. So here it is all about bill of exchange. Sometimes we may have the promissory note also. Promissory note. The difference between bill of entry and the promissory note is nothing but where A drafts and sends it to payer, means the debtor, making to accept and get it back. On the maturity date, you show this and collect the money. That's what about the case here. Is that clear? And in case of promissory note, B he himself promises. I promise to pay 1000 rupees for the goods I taken. He himself. So if B says, give me a bill of entry, I will sign. A says, I don't know how to draft a bill of entry. No need to worry about, sir. I will prepare myself. So B he himself prepares. I promise to pay 1000 rupees. Okay, for the goods or value of the goods received in 3 months' time from the term of bill. Is that clear? That's how he promises he himself. If he promises, acceptance not required. Isn't it? He himself promises, no acceptance is required. But in case the bill is drawn by third party and making others to accept, then he has to sign accept it. Okay, that's the main thing you have to understand. And this will be the drawer of bill, drawer and acceptee. And this will be drawee of the bill or acceptor. And this will be bill of entry, bill of exchange. Instead of bill of exchange, we sometimes have the I promise to pay. Okay, promissory note. Okay, this is not promissory note. So that's how the document is prepared and made it accepted by the other party. Now A keeps it till maturity. Till maturity means, first you understand date of bill. Date of bill. Clear? Date of bill in this case being 1725. 1725. And term of bill. Term of bill. The term of bill being 3 months you have to add. If I add the 3 days with this, 11025 will be the due date of bill or expiry date. Due date or expiry date. It means the acceptor should pay the amount exactly on this date. If he fails, then 3 more days will be given for the grace. Okay, add grace days. That will be called grace days. Another 3 days will be addable. 4/10/25 will be the maturity date. Okay, maturity date. This is called maturity date of the bill. Clear? So by this date he has to settle confirm. So he may be given a time cushion for these 3 days, grace days. So from the date of bill and the term of bill, you will finalize the due date. And after adding the 3 days, you will get the maturity date. By the time you have to get the amount collected. So what happens here? A on maturity date sends the bill to B and B makes the payment for this bill on the date. Which date? Exactly on this date, 4/10/25. Is that clear? This is what about the maturity date. So A sells the goods and for any amount recoverable from B, A drafts a bill and sends this bill to B and making B accepts the bill and get it signed and he keeps in his own document. On maturity date, he sends the bill to B and gets the cash for that. This is the bill of exchange and model collections. Now remember, if the maturity date could be either government holiday, normal holiday, or emergency holiday. Emergency holiday. Okay. If fourth, maybe because of some reason already the holiday is announced by the government, it is available already in the government's notification. So you see what are the holidays are this in this particular calendar year announced by the government. You will have lots of days, holidays for Pongal, New Year, and Diwali and all, right? Some national leaders on those days also holiday may be announced. Suppose the 4th October seems to be government announced holiday, the maturity date should be a day ahead. 3/10/25 will be the maturity date. 1 day ahead. If 4th becomes an emergency holiday, announced only exactly on 3rd or 2nd, 2 days ago or 3 days ago only announced, like a national leader may expire, died, and immediately government announces as because of the death, condolence is there, so we'll announce the holiday for this. Or some other strike, some other riot happens, immediately government announces and you should not come out, lockdown, so you should not come out. In those cases, that is called emergency holidays. Usually, as per the Negotiable Instruments Act, government will notify this date will be declared as holiday, emergency. Okay. In that case, I'm not sure whether I will pay on 4th or not. 4th will be working day or not. I'm not sure I had. So only on 4th I came to know that this day is holiday, so I got stuck. So I may pay that in the next day. 5/10/25 will be the day on which I have to make the payment. Emergency holiday. Hope so you will understand all these concepts. Okay, let's see. Bill of exchange. Bill of exchange. I'll give all the theory here. Now, legally binding document. A bill of exchange is a financial instrument. Okay, financial instrument is nothing but check, bond, whatever it may be, debenture, all these things are financial instrument. Financial instruments where you can convert that to equivalent money represented in that financial instrument. That serves as a written order from one party to the another. Drawer orders this to pay to the another party who is the drawee. Specified amount of money to a third party. Third party may be the payee. Payee may be whoever it may be. See, in this case, on the maturity date, A should pay this money. As A should pay the money, he is called payer. To whom the money should be payable? If the money is payable to A he himself, then A is the payee. But A is not necessarily being the payee because A can simply hand over this bill to banker and later on banker can give the bill and get the cash. This way also happens. So I promise to pay in your currency, in our currency, signed by governor, right? I promise to pay means you don't approach the governor to get the 100 rupees back, right? Whoever you hold, then that money's worth is now payable by the means the governor. So you can simply transfer. You can simply transfer. Similarly, if it is being the bearer bill, A can simply transfer to anybody else. That anybody can encash it from B later on. Is that okay? Similarly, A can simply transfer to the banker and get the cash. Sir, keep the bill today itself. Give me the cash now. Such a way, A can approach the banker and get the cash. Banker sometimes later sends the bill to B and he gets the cash. This process is called endorsing. In this case, banker is the payee. Okay, in this case, A is the payee. Who is payee? Always the recipient is a payee, right? Now, suppose A wants to make a payment to one of the creditors, probably C. So C demands, sir, settle my due, sir. Immediately A says, no worries, sir. I have the bill. You take this bill, sir. And C in the later period gives the bill to B and gets the cash. As I settle the due payable to C, for that this bill is handed over and settlement is done. In this case, C is the payee. Who is the payee? C is the payee. First case, keep till maturity and in cash. Keep with us. Okay. Keep with us till maturity. Second one is all about discounting with the banker. This term is called discounting. Third one is all about endorsing to third party. If you are keeping it till maturity by yourself, then you are being the payee. If you are discounting with the banker will be the payee. If you are giving to some creditors for the settlement of due, hereafter C will collect the money from the B, so C will be the payee. So that's how the statement is clearly given. The payment will be made to third party, whoever it may be, the payee. So party 1 A, party 2 B, party 3 may be banker or C, whoever it may be. Whoever it may be, if we are being the holder of the bill of exchange, can encash when predetermined future date. That's what about the small theory about the bill of exchange. We have studied all these things here. And I have given the illustration here. Goods sold in credit, where bill drawn and sent to B and bill accepted and written by B to A. Clear? So for A's point of view, B being the debtor or drawee or acceptor, and B's point of view, A being the creditor, drawer and acceptance. Three options are there. Option number 1, keep till maturity. On maturity date, bill is sent to B on maturity and cash is remitted. Option 1. Rather than that, he can give this to the bank and get the cash. This is the first part. Okay. So A gives this bill to bank and gets the cash. And later on, bank on maturity gives it to B and gets the cash. Two parts are there. I am handing over to banker. This process is called discounting and I am getting the cash. And banker will give the bill later on maturity to B and encashes it. The third option is bill endorsed. Bill endorsed is similar to the same case, but rather than I am giving to the banker, I hand out to the creditors for my due. So on endorsement, bill is given to the creditors. Because of that reason, debt is paid like, means the due is settled like. And creditors on maturity hands over to B and encashes. So these are the three options we have. Is that clear? Hope you will be now able to understand. I have given the format of bill of exchange in Singar Academy text in detail. You can see this. I explained already. And let's see. Let's see. Yeah. Here, date of bill is there. You have to find out the due date and maturity date. For due date, what do you have to do? Add the term of bill. The term of bill here being 3 months, 2 months, 80 days. Okay. If I add 3 days, what happens? 3 months. 1/5/2024. Okay. 1/5/2024 will be the due date. Due date. Either it may be named as due date or expiry date. Expiry date of the bill. So, 1st May 2024. Second case, I have to add 2 months. 31/12/2023. Come on, add 2 months with this. Huh? Add 2 months and get me the value. So 28th to 24. Should not get confused. 31 means you should not take 31 February. We don't have 31 days in February, right? So only 28 or 29. Maybe if it is being the leap year, you have 29 days. I think 24 is the leap year, right? Isn't it? So leap year, then you have 29 days. So I can convert this to 29 days. Is that clear? Okay. Isn't it? Then what more? In case of 80 days, how can you calculate, sir? In case of 80 days, how can we calculate? Now, February 24. In February 24, how many days are there? 29 days. Leave the transaction date. Leave the transaction date. So we have 28 days. So out of 80 days for February month, We have completed how many days? 28 days. Okay. Still how many days are in balance? Still how many days are in balance? Huh? 52. Am I right? 52. Then March 31 days out of 51, 52, 31 has gone. So 21 days still there. April, naturally 21 will be the date. Okay, the last date will be included. The last date will be included. So 21st April 2024 will be the due date or expiry date. For maturity date, what do you have to do? You have to add grace day also. The number of days applicable for the grace days in this case being 3 days. Add with the days here. 1/5/2024 becomes 4/5/2024. And in this case, leaving this date 29th February, March 1, 2nd, 3rd. 3rd March will be the maturity date 2024. The last case 24/4/24. This will be the maturity date. Maturity date. Is that clear? Hope now you'll be able to understand. Okay. Any doubts here? So here it is clearly given. Here you can convert that to 29 days. That's all. The rest will be the okay. Okay, all these things are clear. So we have completed all these things. You can make a note of this. If you have any doubt, you can ask me. So else we'll now start with the illustrations. See, the bill due date is public holiday. The preceding business day will be the due date. If the due date is emergency holiday, the next following day will be the due date. Already we have studied this one. Sometimes the bill may be called as bill at sight. Bill at sight, for those types of bill, we don't have the grace days. We don't have the grace days. A good example for this being check. If you give the check to the banker, the moment the banker sees, immediately he has to settle the payment. He will not say, give the bill, come after 3 days. He cannot say so. So check is one of the beautiful example for the bill at sight. Bill at sight is nothing but on demand. Whenever you call for or you show this at sight or you are presenting to third party, whatever mode may be, the bill will be encashable. That is called bill at sight. Some bill may be after date. That's what we have now discussed. After date means after a period, say 3 months, or after some day, specific day, on specific day, probably day of settlement may be 5th October 2025. Signed on which date? 7th July 2025. After sight, the moment you are presenting, from the date he takes at least 1 or 2 days or 1 week. On happening certain event, okay, on certain event after, he can settle that. These are the different types of bills may be there. Is that okay? Now, the main difference between promissory note and bill of exchange. You can expect these things in theory, at least 1 or 2 marks question. You can expect the difference between promissory note and bill of exchange. Promissory note is also a legal document, and it's a written promise where promise by debtor to creditor. A sells goods to B. B is the debtor. No, he himself prepares, I promise to pay. Okay. The bill will have the term promise here. From the borrowed to repay the lender. So he has to repay the specific amount with the predetermined rate, along with the agreed upon interest rate. If any interest will also be applicable, that will also be stated in the promissory note itself. That's called promissory note. So the main differences between bill of exchange and promissory notes are number of parties. In bill of exchange, we have 3 parties: drawer, drawee, and payee. Okay, drawer, drawee, and payee. Okay, clear. Now, in case of promissory note, we have maker and makee, low voltage. Immediately, it affects our telecasting. Okay. Maker and payer. So, here, the debtor will prepare the bill, no, promissory note, no, I promise to pay. So, he is called as maker. Later on, he makes the payment to whom? Whoever the bill or promissory note holds. So, he is called payee. Promise or order. Bill of exchange is the order, promise is the promise. Okay, A demands or orders B to pay the money in 3 months for the value sold. In case of promissory note, the debtor he himself says, I promise to pay. And nature of liability. In bill of exchange, secondary and conditional for drawer. Okay, in case of promissory note, prime. Yeah. So, number of parties, promise or order, we have seen. Nature of liability, bill of exchange. In case of bill of exchange, we call secondary and conditional for drawer. In case of promissory note, primary and absolute for the maker. Is that okay? I need to explain this in detail. So I'll discuss that bit after. Acceptances in case of bill of exchange need, because drawn by third party and drawee should accept only, then that bill becomes valid, otherwise invalid. But in this case, no need, because he himself writes, I promise to pay. So no acceptance requires. Payable to bearer. Okay, usually in bill of exchange, it may be payable to the bearer. Whoever the bill of exchange is holder of the bill of exchange can encash. But in case of promissory note, no such information. It's usually payable to a registered person. Protest for dishonor. Protest for dishonor, required, not required. Notice of dishonor, required and not required. So, if the bill is not paid promptly, honored promptly, then protest or notice will be required for bill of exchange, and in this case, not required. In this case, not required. That protest and notice also you have to study separately later on. Okay. So, primary and absolute for maker. Let me finish up this concept here. Okay, this concept here. A and B. A and B. Okay. So, A draws the bill and B accepts the bill. Right. A draws the bill and B accepts the bill. A can give this to some third party, C. Isn't it? So, A has to make a payment of 1000 for C. B has to make a payment of 1000. So, A sold goods for 1000 rupees in our illustration. For that, B has to make the payment. A has drawn a bill for 1000 and B accepts and sends the bill to A. Now, the bill is given to C for the due payable to C. And C says, okay, sir, your due is closed. Your due is closed. Later on, C gives the bill to B and gets the cash. Gets the cash. Is that clear? This is called endorsing of the bill. This is called endorsing of the bill. Clear? Now, who is liable to pay the cash if there is any default? Who is liable? On maturity date, B says, I cannot pay. Or he says, I don't have money. Then what happens here? What happens here? A's responsibility is there to pay to C. So, naturally, B has to pay for the bill, number one. If he fails, then A has to pay, secondary. So, conditional for drawer. A is a drawer. For him, condition is there. What is the condition? If B is not paying, it's A's responsibility to pay. First liability is for B. If B is failing to pay the due, automatically now A has to pay. A has to pay. That's why for the drawer, the liability being secondary and also conditional. What is the condition? If B fails, and it's A's responsibility to settle the money to C. Such case will not be there in promissory note because only two parties are there. A himself commits to pay. Now, the entire responsibility is only on the maker. In case of bill of exchange, A gives this bill to third party, stating that no worries, sir, B will settle this money. If B fails, sir, no problem, I am here. So, I am giving secondary responsibility also. Is that clear? Hope now you will be able to understand the nature of liability. In case of nature of liability, in promissory note, maker is sole responsible person, primary. In case of bill of exchange, the drawee is the first person responsible. If he fails, automatically what happens? Drawee's responsibility will come. His responsibility will be the second. That's why it is called secondary and conditional. Now, protest and notice. Okay. Maturity date, he has to pay the money. Okay. If he doesn't pay, legally I have to make the action on him. I have to make some legal action on him. For the legal action, I need to get legal notification or notary. Okay, I have to get certification from notary public. We'll study that in the subsequent lecture. That is called noting, signed by notary authority. That will be called as noting charges as well as protest. So we'll study that along with the illustrations. Not now. You don't need to worry about that now. So currently, you could be master of these points. What are they? Number of parties, promise or order, and acceptance needed or not needed, payable to bearer or anybody. We have studied all these things. And one more point is all about nature of liability. In case of promissory note, maker is absolute liable person. In case of bill of exchange, drawee is the first person to settle this. If he fails, then automatically drawer will come for settlement. Is that clear? And 6 and 7 we can see that later on. Now, this is one of the easiest chapters, but we can get complicated illustrations at professional level. So we'll study all these things in detail so that we'll be mastered with this chapter by studying all the illustrations given in Singar Academy's text. Types of practical problems. Okay, usually honoring. Honoring is nothing but on maturity date. So B settles the payment. Okay. Either it may be to A. If the bill is discounted with the banker, B will settle the money to the banker. If the bill is given to A's creditor, the payment is done by B to C without any problem. But what happens in reality, there may be chances that this may be defaulted. So B says, I cannot pay. If B fails to pay, then that scenario is called dishonor scenario. How can we consider? That's the most important component. So honoring will be pretty simple, where the dishonoring, the payment is rejected. No, in that case, it's called dishonoring. How can we treat? That will be the second part. So these are the two parts are going to be studied here. Okay, two predominant parts. One is all about honoring situation. Another one is dishonoring situation. Dishonoring means is the drawee is not paying. If he is not paying, what happens? I have to take the legal action on him. No, to take the legal action, I have to confirm that the bill is not met on the due date. It's not honored on the due date. How can I get the certification that this bill is not met on the date? Go to the lawyer. Usually, the lawyer who is specialized in certifying that this bill is not met on the due date is called as notary public. Usually, his main job is notifying some attestation, like legal attestation, like you'll get attestation from the lawyers. The specialized lawyers giving such an attestation is called notary public. Is that clear? So from that notary public, you will get attested that this is not encashed on the due date. For that, you have to pay the fees. That will be called noting charges. That process is called noting. Hope you will be now understand the concept of noting. Noting is nothing but attesting that the bill is not honored properly. Done by whom? Notary public. Will it be involving any cost? Yes, that is called notary charges. Noting, notary public, and noting charges. Sometimes the drawee, he himself comes, sir, I don't have the cash, sir, don't take the legal action. I'll say I may pay some extra for the interest and give me one more time to settle this. Such a way he can approach. It's a mutual. Then I don't want to go to the advocate. So that may also be done possible later on. So we'll study all those things. In that case, also dishonor but without noting. Dishonor with noting, without noting. Okay. Mutual cancellation. Mutual cancellation cost called without noting. Now, we'll try to finish up these cases. Keep till maturity, discounting bill, endorsing the bill. All the three. Honoring situation. I try to finish off honoring situation. Similarly, In case of dishonoring situation, how can we handle? So almost 6 illustrations are related to this one. What are they? Okay, bill get maturity and I keep the bill till the maturity and encashing. First scenario. I'm giving the bill to the banker and on maturity is promptly met. This is the second one, discounting and honoring. Third one is I'm endorsing to the third party and maturity is honoring. These three scenarios, three illustrations. In all the three cases, if dishonoring happens, what can we do? So almost 6 illustrations. Thereafter, there may be renewal of the bill, retirement of bill or rebates, bill sent for collection. So these are the variants you have to study. So one illustration where I have given all the aspects. Question number 1. In your Singar Academy text, I have given question number 1 with almost 10 subdivisions. All the 10 variants are going to be covered here one after one. Is that clear? I may be solving this one after one slowly. Let's start with the first one. So in this very first class, I may try to finish up 3 types here. What are the 3 types? One is keep till maturity and honoring, discounting and honoring, endorsing and honoring. So these are the 3 scenarios we are going to study. Come on. We'll start with the journal entry, passing the journal entry here. Okay. Let's see. On 1/4/24, A sold 800 worth stocks to B for 1000 in credit. A, B. A sells the goods to B. Goods 800, profit 200. The date being 1/4/24, isn't it? You can copy along with me. Come on. On the same date, A drew a 3-month bill for 1000. So 3-month bill drawn and sent. Bill drawn and sent for 3 months. And acceptance received from him. Thereafter, he reads and okay, he says, okay, all the conditions are acceptable. So I sign here. So acceptance is sent. Acceptance is sent by B to A and A keeps this till maturity. Right. A keeps it till maturity and met by B on the due date. So what happens? A keeps till maturity. What's the maturity date? Add 3 months term of the bill. Add 3 grace days. So maturity date being 4/7/24 will be the maturity date. On the date, A sends the bill here and gets the cash here. Is that clear? Now you have to pass it 3 journal entries. In the books of A as well as in the books of B. I may pass the journal entry in the books of A as well as B parallelly to clarify the idea. Come on, tell me. What is the first journal entry for the sales? 800 rupees worth of goods sold for 1000 by adding 200 rupees profit. What is the journal entry? What is the journal entry? B account debit to sales, the value being 1000. What is the second entry? Drawn and accepting the bill. For this, second entry will be passed. Second entry. So now I'll get the document. The document is called bills receivable, a real account like. So BR account debit. BR account debit to B account. This value being 1000. B is now cancelled. Debtors now cancelled. Thereafter on maturity date, third one. What happens on maturity date? We get the cash by giving the BR. Bank account debit to BR. Bank account debit to BR. Is that clear? The value being 1000. That's all. For a better understanding, you can do this way. B account debit, B account credit cancel. BR debit, BR credit cancel. Ultimately, we have what? Bank and sales. That's all. So only sales journal entry, but amount not collected immediately. So first one being the credit transaction. Second one is his name is converted into BR. Third one is we are collecting the money for the BR. What happens in the books of B? What happens in the books of B? Just repeat. For him, it is purchases. Am I right? Purchase account debit, payment to be made to A being the creditor here. The value being 1000. Second one being A account debit to, for A it is BR, bills receivable. For B it's bills payable. He has to pay no. So you name this being bills payable. Bills are receivable and bills payable 1000 rupees. On maturity date, B has to take the bills and settle the money. So for that the journal entry being bills payable account debit to bank. In simple sense, you can cancel all the three journal entries to make it single. So where A credit debit cancel and B credit debit cancel. So ultimately purchases to bank. That's all. So first entry is all about credit transaction. Second one is the creditor's name is changed to the bills payable. Later on being the settlement for that. Clear? Now listen. Past journal entry under the following each situations. We have been given 10 situations. Along with the impact on balance sheet, what could be the impact in the balance sheet for after every transaction? First case. What happens after the first transaction, sir? Okay, first transaction. Stock reduces by 800. This become 1200. Am I right? Profit increases by 200. This becomes 3190. And instead of that, we get the debtor B, his value being 1000. Now the value being 7000, 1200, no BR, cash 1000. Here capital remains undisturbed. This is not required, but for the understanding I have given here. Now the total being 10,200. 10,200. Is that clear? Hope you will be now able to understand first part. What happens after the second transaction? After the second transaction, B is cancelled. Instead of that, we get what? BR. Then rest of the balance sheet remains as it is. Of course, not required, only for the understanding purpose I am guiding you. You don't need to copy this. Learn this. The logic, how this will have the reflection in the balance sheet. Just understand, that's more than enough. Not as in the exams, you no need to work out that also here. But journal entries must. Okay. The third block is all about final settlement. So BR is cancelled. Cash is increased to 2000. That's all. Okay. So the last one being, this one is totally cancelled. This will be 2000. Rest will be the same. Hope now you'll be able to understand. That's how the balance sheet gets affected. Shall I move on to the next one? Only journal entry is required to be copied. How this will have the impact in the balance sheet? Not required. I want to ensure what about the contingent liability here. To make you understand the contingent liability, I'll just explain the concept behind this balance sheet impact. That balance sheet impact is very, very important to know contingent liability calculations. So only I'm giving, but it is not for your exams. It's not for your exams. Is that clear? Shall I move on to the next one? In the second question, everything is same but discounted with the bank. Yeah, come on, pass the journal entry. First few journal entries are same. What happens here? A sells goods to B. worth being 800 by adding 200 rupees, sold at rupees 1000, and A second draws the bill on B. B reads and accepts the bill and sends this to A. A is not keeping the bill till maturity. Simply he gives the bill to the banker. Okay. A discounted with banker 940 and met by B on due date. So what happens? A gives the bill to banker. The bill value is 1000. But cash received for the bill is only 940. What about the 60, sir? That is not nothing but discount. Banker says, okay, give the bill. I will give the cash. I'll wait for the 3 months and I'll get the cash from B 3 months later. 3 months later. But 3 months ahead, I'm paying the money. No, you just give me some interest. So naturally, 20 rupees interest per month, sir. So for 3 months, 60 rupees will be the interest. I deduct that and I'll settle the balance. So the transaction happens on 1/4/2024 and discounting happens on the same date like 1/4/24, but banker encashes only on 4/7/24. Banker gives the bill and gets the cash on which date? 4/7/24. Banker says, I give the cash for the bill on 1/4/24, but I'm encashing this only on 4/7. 3 months later, as I'm doing the banking business, I need interest. For the delay for the 3 months, you have to give me the interest. That's all. So the interest is subtracted and A gets 940 today itself. He is pretty happy because he gets the money today itself. He gets the money today itself. This is called discounting. I hope you will be now able to understand why we use the term discounting. Discounting means whatever the bill I have, I give the banker, but I won't get the full value. I'll get small money lesser than that. Usually that small money related to the period for which the interest is applicable. So in the books of A as well as in the books of B. In the books of A and in the books of B. First journal entry is all about sales. In the books of A, the journal entry being, come on, B account debit to B account debit to B account debit to sales, the value being 1000. And in B, I will finish up B's record later. Second entry being for this sending, drawing the bill and getting the acceptance from B. I'm getting the BR. BR is my asset, so debited to B account. B is now released. And later on, I send the BR and get the cash. But the BR given to whom? Banker. So the third entry. Bank account debit. How much I am getting? Only 940. Actually, the bill value being, BR value being 1000. And the difference between these two, 60, you know, called discount. Discount on bills discounted. This is on this date. What about the journal entry for 4th maturity date? No entry. No entry in the books of A. Is that okay? This will be on 1/4/24. This will be on the same date 1/4/24. And this will be also 1/4/24. And this will be on 4/7/24. 4/7/24. Is that clear? In case of B, on this date 1/4/24, okay, he purchases the goods. The journal entry being purchases account debit, purchases account debit to A account. The value being 1000. Later, B accepts and sends his acceptance to A. So A is cancelled. Instead of A, now we have bills payable account, 2 bills payable. This value being 1000. Okay, this date being 1/4/24. Next one being 1/4/24. While discounting the bill with the banker and maturity date 4/7/24. Come on, tell me. What about the journal entry while discounting the bill by A in the books of B? Come on, what is the journal entry? He takes no action. He takes no action. No problem, sir. Whoever it may be on maturity date, let him come to me with the bills payable. I'll settle this. So banker approaches B only on maturity. Maturity on 4/7/24. On the date, B settles the money to the banker. The entry being bills payable upon debit to bank. The value being 1,000 to the banker or bearer or the bearer. Is that clear? Hope now you'll be able to understand. Now, what about the impact of these three transactions in the balance sheet of A? In the balance sheet of A. Let's see. I'll explain the impact. Okay. Impact. Now, the impact on the first date. The impact on the first date. B account for this first transaction, stock is decreased to by 800. Then this becomes what? 1,200. And it increases the reserves, the value being 3,190. And B account will emerge now as a new 1,000. This is the journal entry. The impact in the balance sheet after the first journal entry. Is that clear? 7,000, 1,010. This becomes 10,200, 7,000, 1,000. These things remain same. 10,200. Of course, balance sheet not required. Only to make you understand one concept, I am guiding you here. Now, after the second transaction, what happens? B got cancelled. Instead of BR will emerge. BR will emerge. This is what about the next case. All other items are the same way it's appearing. No change in the liability side. No change in the liability side. Is that clear? Is that clear? What happens for this date? This is as on 1/4/24. Now what happens for this date? I can make it 4th April, 4 days later. I am going to prepare the balance sheet. I am going to prepare the balance sheet for as on 4/4/24. As on the date, bill got dishonored. What could be the journal entry? I don't touch the fixed asset, that remains same. Stock, that value also remains same, unaffected. What happens to B account? We don't have balance in B account already. Now what happens to the BR? BR is cancelled. BR is cancelled. Hereafter BR being nil. BR being nil, cancelled. Instead of the, we have the cash already 1,000. Because of this, we get one more 940 excess. 1,000 plus 940, 1,940. 1,940. Is that clear? What happens after adjusting this journal entry in the balance sheet? Cash and bank interchangeable, that balance increases by 940. BR already we have 1,000, by crediting it becomes 0. And discount we have, that discount will have the impact where? In P&L account. In P&L account. 6,000 reserves. Already we have 3,190 profit. But because of the discount we are losing, it's an expenses. can be adjusted only in 3190. If I adjust, then the value be 3130 is the new value for the resource. That's all. The other things remains the same. Capital okay, this is adjusted and creditors remains same. C 1010. Now the total being come on 11,160, I think. 10,160 or 11? 10,160, am I right? 140. Okay, 10,140 is the answer. 10,140. Use a calculator, others also. Don't be idle. Make it faster. Okay. 10,140. Clear? Any doubts here? Clear? Now come on. Is the balance sheet complete? Is the balance sheet complete? Or is it having any problem? If you want to purchase this company and the seller says all the assets and liabilities appearing in the balance sheet will be worth for the balance sheet items value, balance sheet value. Okay, he says, give me the cash. You take my business. I want to purchase this business. If you want to purchase this business, 7,000 plus 1,200 plus 1,940, 10,140 is my asset value, 1010 being my liabilities, and 9,130 will be the value of the business. Am I right? 9,130 being the value of the business. That 9,130 is nothing but owner's fund. Existing owner says, sir, you take my business. My worth in this business is 9,130. You can take. I cannot run hereafter. You can run. Now the question is, shall I purchase it for 9,130? 9,130, is it worth or not? If I pay 9,130 and purchase this business, that original owner is now abscond. He is not there. I purchased it from him. I purchased the business for 9,130. He has gone. Clear? When it is happening? 4/4/24. 4/4/24. As per the information given, I just prepare the balance sheet. But what happens, on 4/7/24, banker approaches B, he fails to pay, automatically he comes to whom? A. Because A's responsibility being secondary. His liability being secondary. Automatically A comes, sir, give me money. Banker will come to A, give the money. Now what happens? I thought 9,130 is the real worth of the company. I paid 9,130 on 4/7/2024, 2024 only I came to know, oh my God, this fellow has not paid. So it's my responsibility to pay one more 1,000. Then if I pay 1,000 rupees from this, I'm actually a user. Is that clear? Are you able to understand the logic? As on 4/4/24, there's a hidden liability not shown anywhere in the balance sheet. Not shown anywhere in the balance sheet. But there's a hidden liability. What's the hidden liability? Some liability may creep when, if a real drawee of the bill failed to pay the money, then it's my response, secondary liability. Unless you state this, and the buyer and the person who is verifying the company's financial statement based on this balance sheet will get confused. So, the accounting standard says, give a note when on 4/4/24, write there is a contingent liability for rupees 1,000 with respect to bill discounted. Now, if I say, take my company, you say your company worth rupees 9,130. Immediately I ask, what about this one, sir? Yes, sir, there's a contingent liability, 1,000. Okay, don't pay 1,000 now. If my drawee correctly pays, only then you can pay. So now what I do, instead of paying that entire consideration 9,130 today, I'll pay only 8,130. I hold the 1,000 to be payable later on. Okay, I'll pay this 1,000 later on. Such a way I just hold that money. Now what happens? We'll go for this date. Which date? This date. As on the date, be paid promptly. As be paid promptly, what happens? The new balance sheet being which date? 4/7/24. The balance sheet remains as it is. Balance sheet remains as it is. Okay. The balance sheet remains as it is as on this date. But one thing happens here. What is that? This contingent liability will be cancelled on which date? On maturity date. 4/7/24. This contingent liability will disappear. If I purchase a company, I pay 8,130 now itself. On 4/7/24, after confirmation that the money is paid by B, I will release this 4,000 rupees. In order to show this one, there's a contingent liability may creep into a liability like in the future. You have to give some hint, no? That hint will be given in the adjustments. Until which period? From the discounting date to settlement date, it will be available as what? Contingent liability. This will be appearing in the balance sheet from 4/4/24 to 4/7/24. This will be appearing. Once the settlement is over, this contingent liability will disappear. Clear?